Welcome back everyone. So today I'm going to be going over the simple moving average and also the exponential moving average. These are two tools that you have at your disposal when looking into technical analysis. Now if anyone is new to the channel, then hit that subscribe button. New videos are posted each week. Let's also check out what the like goal is going to be set to this week. So hitting the generate button, we have a goal like of 42. So first up, why are we looking at these different types of averages? Well, the main reason is that they are technical indicators and they can help in determining whether a given price is going to continue in a bullish direction or whether it's going to decrease in a bearish direction. Now, the moving averages also act as a support and resistance level, and so it's an indicator that tells us when we should buy and when we should sell. So let's understand the simple moving average a little bit more. It's generally referred to as the SMA, and it's generally calculated by adding the closing price of the stock for a set number of time periods, and then it divides the total by that same number of periods. Now as an example, I'm just going to pick a random ticker symbol. Let's go with Nike for today's example. And under most popular, let's add the simple moving average. On the right hand side, we have the period set to 14. So what happens is the last 14 days will be used in the calculation. It will take the closing prices of those 14 days and then divide by 14, and then it will plot the single point with all that historical data, and it just repeats the process to give us this continuous curve. I'm just going to make the line a bit thicker. Now if I change the period to say 200, we can see that the curve is taking a much wider sample, and that's because it's using the past 200 days in the calculation for every point. If we make it more stricter, then we can have a moving average of 2 days and it will track with a slight offset. So by default, the 14-day period is fine. This is especially true for traders that like to buy and sell in quick succession. You can always increase the value if you are a long-term trader, but personally I feel as though the 14-day period is perfectly fine even for long-term traders. This is because you can continually buy into a stock, but you can benefit from price movements in the short term, which allows you to buy the stock at a cheaper price. So let's take a part of the curve. So the SMA at the moment is underneath the candlesticks. So with the candlesticks all above the SMA line, we can see that the market is in a bullish upward trend. And then if we continue and look down here, the candlesticks are below the SMA line. So this is a bearish point in time. And so going back to when there was a bullish moment, we can see the candlesticks are increasing and then they test the SMA line. And so going back to the 3rd of November, we can see that as the days increased, we get closer and closer to the SMA line. On the 11th, there was a test on the SMA, but it didn't go below the line, it decided to go up. And so here the stock tested the SMA line, and the SMA is considered as a support level. As we move up the curve, we can see again there was a test, and this took place on the 3rd of December, and then subsequently another test on the 17th of December. Now there's another test that takes place, and all in all the price of the stock trends upwards, but it's not until we hit the 13th of January that we cross below the line. We can see that we have a trend reversal. So this is where the price crosses the SMA line, and then just continuing until the 20th of January, we can see that we have a test on the line, but the price doesn't go above it, it stays below. And so the SMA now acts as a resistance. And so as time increases, we can see that there's another test. We have a trend reversal that takes place where the candlesticks move above the SMA line, and now we're at the bullish part of the cycle. And so when you want to enter these types of positions, ideally you would have been studying the graph from the 26th of January. Realistically, you would have brought in on the 3rd of February because you would wait until the price goes above the SMA line and then continues to increase. And then you'd hold your position and you would continue to hold given the candlestick is still above the SMA and it hasn't tried to test the SMA yet. So the SMA is one of the most simplest indicators. The one downside it has is that when we have this period of 14 days or whatever number you choose, it provides an equal weighting. And so when it calculates the point, let's say the 16th of November, this very point is calculated by looking at the past 14 days and it provides an equal weighting. Now the problem is that not all days move in the same amount. And so with the SMA, it's much more averaged out in that the line doesn't really track how the candlesticks are moving. It has more of a distance. Now for sure you can increase this value to track more closely, but then you're limiting yourself to just 2 days. And so that's not a really good idea. And that's why I'm also going to be covering the exponential moving average, also known as the EMA. So on most popular, we have the EMA. Let's enable that. I'm going to change the color just so it's more clearer. And let's add the thickness to this line. So I've still got the SMA, that's the blue line. And I've got this thick black line, which is the EMA. Now just to make this comparison the same, I have the 14-day period on the EMA that matches what I have on the SMA. And already we can see that the SMA is pulling towards the candlestick movement a little bit more to that of the SMA. Now of course at periods where the price is a little bit more horizontal, there are times when the SMA might track more closely, but we're more interested in the extremities. So for instance, when the price is on an uptrend or when it's on a downtrend. And at those moments, we can see that the EMA is tracking much more closely. And so all the points regarding SMA is exactly the same in terms of the uptrends, downtrends, support and resistance. But the benefit is that we have more of a weighting towards recent data points. So for instance, when the EMA calculates this given point on the 12th of November, during the 14-day calculation, it would have provided more of a weighting to the 11th and the 10th of November, and less on the likes of the 2nd of November. Now, as with the SMA, we can change the EMA in terms of the period. So standard numbers are the 10th day EMA. You can also look into the 50-day EMA and also the 200-day moving average. Now for short-term traders, it makes more sense to have a lower number. Generally speaking, long-term traders are more interested in a larger period, given that they're going to hold onto their stock for much longer periods. But as I mentioned with the SMA, if you're into buying stocks on a repeated basis, then having a shorter period actually makes more sense, given that you can get the best price during that shorter period time frame. Now for a trader like myself, I can use either the EMA or the SMA for my style of trading, and especially when it comes to the likes of growth-based stocks, or even to a lesser extent dividend-based stocks. Using either one gives me the same amount of information. For people that buy shares and want to exit a position within a day or say 2 weeks, then they definitely want to focus on the EMA, given the smaller distance between the candlestick and the actual line. The main call out for both of these averages is that they are just that. They are an average of past performances. And so that's all you need to know when it comes to both the SMA and the EMA. In summary, it acts as an indicator on whether we should sell a given stock or if we wish to buy. Now, day traders use this all the time, but for long-term investors as well, it can help us get some of the cheaper price points when buying into a stock, and we can focus less on whether to sell or not. We also have an indicator on resistance and support levels, and then we can see when the price tries to test the levels and see if it bounces back up or whether it breaks and then operates in a bearish trend. So in the comment section, let me know if you have any questions regarding either the SMA or the EMA. Last week I did a video on the MACD, so check that out if you are interested. And equally, if you're finding these videos of use, do let me know. I'm happy to do more in the future. I have the opinion that whatever type of investor you are, whether you're a short-term, long-term, you should be able to appreciate all the different tools available and the different styles of trading. And who knows, you may be able to learn something from one area and then combining it into your respective type of trading. So as I mentioned earlier, if you haven't done so already, and if you enjoy this type of content, then definitely subscribe. New videos are out each week. If you have any suggestions which you would like me to cover with respect to technical analysis, then leave a comment in the comment section below. And with that said, I'll catch you in the next one.